Hi, Tasty Nation and Investor Nation. Today I'm going to answer the question, what do you do when the market kicks your ass? If you clicked on this video because you thought this was the one video on YouTube that has some magic bullet to save your account after the fact, then I'm sorry to say that no such video exists and no such magic bullet exists. But I will talk about some minor things that you can do to help with your account, and I'll also talk about some lessons I learned in my trading this year. So what do you do when the market kicks your ass? You're down on the ground already, and then the market stomps down on you with its boot right on your neck. Well, to be honest, there's not a lot you can do after the fact. You got to take this as a learning experience and realize the fact that you define your risk at order entry, and it's always going to be that way. Having said that, here's something that you don't do. You don't panic. You don't add to losers. Adding to losers would be to add more capital to a trade that you're already in. We don't do that. If it goes against you even more, you're going to have double the pain. We don't stop trading. As premium sellers, we live for high volatility. So when the high volatility environment comes, this is where our opportunity is the best. So the transition from a lower volatility environment to a higher volatility environment might be painful at the time, but once we're in the high volatility environment, we want to keep trading because we want to reap the benefits of high premium. And I really don't like the idea when someone says, I'm going to sit out of the market right now because the current environment is not working with my strategies. Well, first of all, a good strategy should work over time with enough occurrences. It shouldn't matter what type of market you're in right now because that's just an opinion. The only thing that we really know for sure is if we have a known good strategy, we can prove that it works over time. And we just have to keep our size intact and keep the occurrences going to actually reap the benefits of that positive strategy. So if anyone says it's a good time to trade or it's not a good time to trade, that's just their opinion. And I try to keep my opinion out of my trading decisions and just focus on the known proven strategies. We don't buy protection. So we don't buy puts, for example, when our account's already down. That would be akin to trying to buy house insurance when your house is already on fire. It would be super expensive to do so. And chances are it's not going to help you anyway, because you're already in the hole and you have to pay an elevated price for those puts. Another one I just thought of for the don't do is don't blame someone else. You got to take responsibility for your own actions and learn from any mistakes you made. So learning from your mistakes, if you got a margin call or if you were forced to take a loss that made you uncomfortable, you have to learn from that mistake and move on. You only need to get one margin call in your life, and then you make sure it never happens again. In Canada, we actually don't even have margin calls. They just auto liquidate positions in your account. And there's nothing you can do about it. You might not even know about it until after the fact. I definitely learned my lesson back in March 2020, and it's never going to happen to me again. So you may need to reduce your size going forward and free up some buying power. Maybe you want to close some positions or define your risk on some positions to free up some buying power. And then you want to improve your cost basis. So if you have the capital to keep your positions on, you can slowly dig yourself out of that hole and slowly chip away at your cost basis. And I'll go over an example of that. It could take a year or more, and the stock has to cooperate, of course. But if the market eventually recovers and the particular stock eventually recovers, you can eventually get back to even, and selling premium can help you get back to even sooner. So that's why we want to use options to sell premium to help us dig out of our hole. Okay, put on winning trades. This idea came from Tom Preston, one of the geniuses at Tasty Trade. He once told me, the only way to recover from a losing trade is to put on more winning trades. Does that mean you maybe close a losing position and take the loss and move to a higher probability trade in another product? Well, maybe. I don't know that there's a right or wrong answer to that question. It really depends on your assumption on the product. If you really think that you want to be still bullish on that product going forward, if you think it will recover. And lastly, you want to live to trade another day. You want to survive and you want to live to trade another day. So whatever mistakes you made in the past, going forward, you've got to position yourself in the future to always be able to stand up and keep playing the game. You don't want to get wiped out and knocked out of the game from a series of bad mistakes. By the way, Tom Preston puts out the Cherry Bomb, where you can get daily trade ideas 4 days a week. And to sign up for the Cherry Bomb, it's free. You just go to tastytrade.com, sign in with your email address, and make sure you have this tick box here for Cherry Bomb. Okay, so now I'm going to talk about reducing your cost basis. If you have a naked put that's gone against you and it's now a deep in the money put, what you want to try and do is try and roll for a credit. So you're going to chip away at your cost basis for that trade and keep earning a small credit every cycle until it comes back. You could also consider assignment of the shares. So if you let a naked put get assigned, you would get 100 shares of that stock, and then you would go and sell a call against that stock to reduce cost basis as well. So whether or not you want to do that kind of depends on what country you're in. If you're in the United States or another country where you're using Tastyworks, you have to consider the assignment fee of $5 and the buying power it will take you to hold that stock. So in the US, I believe it's 50% for a stock trading at $100. Instead of putting up the full $10,000 for 100 shares of the stock, you would only put up $5,000. In Canada, it's actually a little bit less. It's 30%. So the example that I'm going to show for trying to reduce my cost basis on a position that's gone against me is BITO. So I have an in the money put right now. Of course, I sold that put when it was out of the money, but because BITO has gone down so much, my naked put at the 23 strike is now in the money. So it's at the 79 delta right now. So that's equivalent to 79 shares of stock. What I'm going to try and do is when we get to around 21 days to expiration, so I still have some time, I'm going to try and roll that from June to July and do it for credit. So I turn on my strategy builder here. If that put was currently trading around $5, I'm going to buy it back and then go to the next cycle and try and sell a put for at least $5 or maybe a little bit more. So I could sell the same strike 23 put for a credit. That will help you reduce your cost basis over time with that credit. And look, this is not affecting my buying power at all. I'm not putting up any more money to do this trade, to keep rolling it. This is what I mean by we don't add to losers, right? I'm able to keep this position on without adding more capital. I'm not adding to the loser. I'm keeping the current position on and trying to chip away at my cost basis and improve my cost basis over time to eventually, hopefully win on that trade. So that's one case where I'm rolling to the same strike. But the other thing you could try to do is try and lower your put strike by at least one strike each cycle. If it was possible to buy that 23 put in June and then sell a 22 put in July, I'm reducing my risk slightly. And if I can do that for a credit, that will help me fight back to even faster. So you can't always do that for a credit, but at least that's something you want to try to do. You might even put in that order as a GTC order and put in a small credit like 3 cents or whatever to cover your commissions. That's what I do. And then hopefully that GTC order will fill before we get too close to expiration. So if you keep doing that, so by July, I might be able to roll down by 1 strike to the 22. Then I do that again in August and I roll down to 21. Then I try to do it again in September and again in October. And by November, I could actually get out of the money. So it's a long process. It takes work. If you can tough it out, it's really worth it in the end. I've done this many times with positions that have moved against me. It doesn't always work, of course. The stock does have to cooperate with you. And by the way, if you haven't seen my other video on BITO, which is the Bitcoin ETF, make sure you check that out, how I like to use it to get long Bitcoin in a strategic way. So I'll put a link to that video in the show notes. Okay, so now that I've covered cost basis reduction, I'm going to talk about some of the lessons I learned trading this year and from the experience I've had in other years. One of the things I want to do going forward is to try and keep my buying power in check. I want to keep my usage below 50% and keep more dry powder for when we have periods like we have right now with high volatility and I see more opportunity and I want to be able to jump on that opportunity, but I have to have dry powder in order to do that.
Do you know what I say to myself every day? Self. I wish I had more money in my account so I could sell more premium. I haven't really been adding much. No one's been adding much. We've had this high vol, market down, but people have been nervous and no one's been adding much because
I have but I started adding, then I added a little bit, then I added a little bit, then I had to stop. I stopped adding. So added, and then I just cut it off.
Of course. So yeah, added. And then at the low, we're done adding because we had to cut ourselves off because we were at our limit and we believe in trade small. So I haven't added much the last few days or so because I've been at my limit. So that's why I would say to myself, I wish I had more money so I could add a little more, but we've been tapped out.
So this idea of buying power usage comes from this Tasty Trades slide, which sort of gives us a rough guideline of how much your account in buying power reduction you should be using in different VIX environments. So right now we're in this environment of around 30% in the VIX. So that means the market is predicting a movement of up or down 30% in the next year. Well, in this environment, we should only be using around 40% of our buying power. And I was actually creeping up more to around 50%. So I was probably a little higher than I should have been. So I want to keep that in check going forward. Of course, when volatility decreases even more, you should be using less of your account because you really got to get prepared for if we do have a volatility spike again. VIX over 30 is pretty rare occurrence. It only happened a few times in the last 5 years. So when the high volatility periods come around, which are pretty rare, we want to be able to participate and benefit from that high volatility. And we know that mathematically, volatility will eventually go lower. That's called mean reversion. We know volatility is mean reverting. So it tends to spike and then it tends to come back down. We just don't know how long that will take. So a lot of my buying power this year got eaten up really quickly as some of my positions moved against me. So that's something I'm going to try and do more in the future. I got to really watch my size. I want to keep my positions to around 1 to 3% of my account size. So you want to trade small enough that it doesn't cripple your account if you have a bunch of losers that go against you. And 1 to 3% of my account in buying power usage is how I would define trading small, trading often. It's tempting to ramp up your size when things are going well. And I've always been a one lot trader, but a one lot in a $50 stock is a lot different than a one lot in a $100 stock. For example, if we're looking at a $100 stock, that's a $10,000 notional value. So a one lot is 100 shares. So a naked put in that product would use up a buying power of around $3,000 or 30%. And the 100 shares would use a buying power of $5,000. I'm using the US example here as a worst case. So following my own guidelines, I would need an account size of at least 100,000 to trade a $100 stock naked. But what about a $50 stock? Notional value of $5,000, only $1,500 for a naked put. And if you got to sign the shares, the worst case would be $2,500. And the other thing I'm thinking a lot more of lately is I maybe want to avoid individual companies altogether and just stick to the indices, the ETFs, and the futures options. Almost all the problems that I had this year were positions that were in individual companies. All my indices and futures options positions have been fine. So why is that? Well, if you look at the normal distribution, generally we like to have our trades fall within 1 standard deviation or maybe 2 standard deviations on a really bad day. But there's always this tail risk out here beyond 3 standard deviations. So even though it's a rare occurrence, only 0.3% of the time, you could have these tail events where a stock price goes way, way down outside the expected move, way out here at the 4 or 5 standard deviation level. Or the same thing could happen on the upside, like happened in GameStop last year. So my thinking is, based on my experience, I only really see these huge outlier events in individual companies. I don't really see them in the indices or ETFs. So maybe if I just stick with the indices and ETFs, I'm still going to get the probabilities to work out in my favor, but I'm going to avoid the very rare occurrence where a stock goes from $100 down to $10 and loses 90% of its value in a short period of time. That's supposed to be a really rare occurrence, but it's been happening to a lot of individual companies this year. Now, speaking of futures options, there was also some big outlier events in natural gas and oil this year, as well as some of the other commodities like corn, wheat, and soybeans. So you have to be really careful with the futures options. They can have big outlier events as well. And that's where I like to define my risk, especially on some of those bigger products. So check out my video on futures options, which I'll put a link to in the show notes if you want to learn more about how I do that. So the last one I have on my list here is going forward, I want to watch my correlation risk a lot better than I did this year. This is something that I have kept in mind in the past, but I could probably do better at. So having a position on in a market indice like the S&P 500 and also some commodities like gold and oil, also some currencies, and also the US Treasuries, that's totally fine because those products tend to be uncorrelated. But what if you load up on a bunch of stocks in your account? All those stocks are equities, right? So when the whole equity market goes down, all those positions can move against you at the same time. So you don't want to be in a bunch of products that are all correlated to each other, that when the market turns, they all go against you. That's correlation risk. I want to try and avoid that going forward. So just try and get more diversification in my positions. And I have talked about this in other videos, but I'm going to do a video exclusively on correlation risk in the future. The last thing that I wanted to mention here as a possible way to recover some losses in your account is consider a zebra. So a long call zebra would give you 90 delta, which is the synthetic equivalent of 90 shares. And a long put zebra would give you 90 short delta, or the equivalent of 90 short shares. So I did a video talking about synthetic stock options, and I even gave an example of the zebra. So make sure you check out that video if you haven't seen it. The zebra, of course, was invented by Liz and Jenny. And the reason why you might want to consider it is, so if the market's down right now and you want to get long the market in a capital efficient way, and also define your risk to the downside, like is shown in this graph here, you could get long the market that way. The trade-off to using a zebra is you're not getting the benefit of premium collection like you would on a naked put. So I'm personally not using zebras in my account right now, but I know other people that are. They just want to get long the market and cap their downside risk and not worry about a market crash. So remember I said selling premium can help you get back to even faster. But if you use a zebra, you're not really collecting premium. So you're really depending on the market direction in order to win on a zebra. But at least you're not paying extrinsic value, which is the point of a zebra. We never want to buy extrinsic value. We never want to buy premium. Well, thanks for watching, and I hope you learned something. Let me know in the comments if you think I missed anything or if you disagree with me on anything, and let me know how your trading is going in 2022. Personally, I'm definitely down on the year, but I'm not too worried about it because I have a lot of confidence in my premium selling strategies, and I'm confident that those strategies do work well over time. I just need to weather the storm and come back from my drawdown. I'm okay with being uncomfortable with certain positions in my account, but I'm not losing any sleep over it. If you're ever losing sleep because of your positions in your brokerage account, then that's definitely a sign that you need to make a change and maybe reduce your position size, maybe define your risk. Okay, well, good luck with your trading this year. I really hope that you have a positive year. And if not in 2022, maybe 2023 will be your year. Thanks for watching.